Uh, Welcome to today's San Antonio Startup Week session for the investment track. My name is Sebastian Garzon, and I am your host and moderator for today's session. A little bit about myself. I am the executive director for Alamo Angels, which is our group of angel investors here in San Antonio. Today's topic is a startup's founder's guide to angel investing. So if you are an entrepreneur looking to raise funding from an angel investor, you are at the right place. If you are an accredited investor looking to learn from people who have experience investing on early stage companies, you are also at the right place. Today's format, it's a panel discussion, and we have a really good group of panelists. They are all angel investors who are very much involved on the entrepreneurial ecosystem here in our city. Now, if you guys are watching from another city, welcome. While our panelists and myself are here in San Antonio, the discussion for today will still be beneficial to you, regardless of where you might be located. With that being said, let's get started. I like to start by introducing our panelists. And for that, I will ask them to tell us their name and share a little bit about themselves. Let's start with you, Meg.
Sure, thanks. So Meg Paulus, I lead investment activities for the Holt family and for Holt Ventures here in San Antonio, Texas. We look at very early stage technologies impacting the industries that we serve. So that's a lot of industrial technology and construction tech as well. I've been in San Antonio for about 2 years. Prior to that, I was in Princeton, New Jersey, where I was doing middle market buyout deals. I am originally from Wisconsin and really enjoying my time in San Antonio. And I guess, of course, most importantly, I'm a board member with Alamo Angels with Sebastian and the other members on this call. So thank you so much for having me.
Thank you, Meg. All right, what about you, Clayton?
Good morning, everyone. I'm Clay Killinger. I'm a certified public accountant and a former executive at CST Brands, which was the retail segment of Valero Energy Corporation. So if any of you out there are buying gasoline from a gas station that has the Valero banner on that, it's highly likely that you are buying gasoline from a former CST brand site. We were acquired 3 years ago by a Canadian company, Circle K, and so you'll see a lot of the stores being rebranded Circle K. I'm now independently retired. I serve on several boards, one of which is the Alamo Angels, and I am an independent investor and an angel investor, and have been active for the last 3 years. So thank you.
Thank you, Clay. Michael?
Howdy, I'm Michael Girdley, and this is not muted, so that's a good first step. So I'm an entrepreneur and investor here in San Antonio, part of the original group that got Alamo Angels going now 4 or 5 years ago. So I'm proud to still be on the board and be here helping. Co-founder of a number of companies here locally, part-time venture capitalist, all kinds of stuff for me, and that's the way I like my career. So my very first angel investment was actually Par Level Technologies, which is here in San Antonio, and has grown to a pretty big tech company, and glad to be continuing on and investing in folks here and beyond.
Awesome. Thank you, Michael. Well, let's dive into today's topic, which obviously is angel investing. People watching today are probably very much interested to learn what goes through your minds as angel investors. What do you think about when you are evaluating deals? What takes for you to write a check? Maybe share some advice on how to successfully raise money. So even prior to answering all those questions, I like to start by asking you guys, how did you get into the world of angel investing, and how did you start investing on early stage companies? Meg?
Sure, yeah. So I've had a little bit of a circular career so far. So I went to school in Silicon Valley. And of course, when I was there, this is what everybody wanted to do, was to be on the VC side of the table. And I was in investment banking at a technology. It was mostly technology advisory that we did. And at that point, I actually joined a company that we had been advising and was reaching out to different VCs within the area and thought it was so exciting and kind of looked at everybody with stargaze eyes. And so after that experience, I actually ended up on the public market side doing equity research with micro cap companies. And so I had a lot of access to the management teams, and it was really great experience for me. So I definitely wanted to get back on the private side, and BlackRock was how I did that, and it was a lot later stage. And so during my time there, I started to once again have this feeling of I wanted to work with founding teams at a lot earlier stage. And so I started to get put on more of those deal teams. And when I was looking to leave, the Holt family and Holt Ventures opportunity popped up. And so now I have a little bit of an even more granular level look at the angel level deals, meaning that I'm really not at all looking at just straight angel deals like I think a lot of people are. We are more strategic. So we're in super early stage deals that are impacting, each of the industries that we're in. And, for me, that helps a lot to have a more specific focus and to get to work towards being more of an industry expert. So it's been a little bit circular for me, but I've gotten into it in a little bit of a roundabout way, but I've really enjoyed it and think it's such an interesting space to get to operate in.
That's awesome. Thank you, Meg. What about you, Clayton? I know you are fairly new to the whole world of angel investing, but you've accelerated your progress when it comes to investing on these companies. And I know that you've read a lot. You've really gotten involved with a lot of people that have been doing this for a while. So what has been your experience on that?
So after the buyout, I was retired. And I manage my own portfolio. I have some investment advisors, and I was doing a presentation for some certified financial planners, and one of them came up to me, who's actually involved with the Alamo Angels, and said, "Hey, have you allocated any portion of your investment portfolio in startup or entrepreneurial companies?" Which interested me, and I had not at that time, and so that's how I actually got involved. Being a former executive at a Fortune 500, actually 2 Fortune 500 companies, anybody who's worked in that space for a long time, and I've been employed for almost 30 years, you have your own circle of contacts within the business community. And one of the big advantages of being involved in angel investing and entrepreneurial type of investing is it's broadened the spectrum of all the individuals that I deal with. Sebastian, yourself, and Meg and Michael. I mean, I probably never would have met these individuals, which are, 1, extremely intelligent, 2, they're fascinating, and 3, it's opened the world to a whole other side of investing that I found, really intriguing to me. It's like all investment portfolios, it's not a tremendously large portion of my investment portfolio, but it is a piece. And so I found it to be energizing for me, especially as I start to work with the companies and perform some mentoring services or advisory services, and people call me all the time. It's a lot of fun to do it, as well as hopefully it'll be a profitable enterprise as well.
That's awesome. Thank you, Clay. And I think you brought up a really good point, which is a lot of times angel investors are not only looking to make an investment, but also to be a little bit more involved with the companies that they've invested on. And that is not the case with all of them, right? But some, such as yourself, you also want to provide that mentorship and that guidance. And I think that's an important aspect of angel investing that sometimes gets a little overlooked. Michael, what's been your experience? How did you get started with all of this?
Yeah, well, I started hanging around Geekdom in 2013, so 7 years ago. And Geekdom, is a co-working place that is the hub for startup activity, especially around technology in San Antonio. And you started hanging out there. For me, I started to meet people. That's how I met the par level guys, which was a great story for San Antonio. I met them there. I got involved in the Techstars program when that was here, and it was just very natural, for me, somebody that comes from the operator side, to start to play around with allocating capital into these very early stage companies. And so it's just a natural thing. You hang around and people think you might have some money. Eventually they're going to ask you to invest it in their business. And it was, it's been a good journey since then.
That's awesome. The first time that I went to Geekdom, Michael, I think it was on the basement. I don't remember where it was, but I saw someone that looked familiar, and sure enough, that was you. You're like a legend in the Geekdom community.
It's very kind. Yeah.
All right. Well, let's move on. Meg, when talking about the early stage companies or investments in general, I feel like an investor, for the most part, they all look at kind of the same aspects when it comes to evaluating what the company looks like and the potential returns that you may get out of it. But is there anything specifically that you usually look for when evaluating an investment deal?
Yeah, there's a few things. So the first thing I would say, and probably the most obvious, and I assume Michael and Clayton feel the same, is the founder. I think when that first meeting with the founder and that management team overall is super important. And in that meeting, this is a very soft checkbox, but the question is, do you want to work with that founder? Because the relationship is really going to last very long, whether you want it or not. And so I think that you have to kind of have a good vibe with that founder originally. The other thing that I look for very specifically in my role with Holt Ventures is the problem that they're solving. So I really try to tap into an expert network to understand what problems that industry is facing, and if the solution that this founder has is really going to be adopted within that market. So those are really the two big things for me. A lot of the things that I'm doing are more near-term bets. So is it solving a problem today? Is it something that can bring efficiency to our operation or our customers today? But when I am looking at deals that I guess I would classify as moonshots that are going to long-term change the industry, the most important thing for me is reference calls on the founder to understand if that founder can execute and what they're like to work with. And at that stage, it's super important that they have the ability to take feedback and adapt to it. So those are really my core pillars to start. And again, I think those are largely impacted by the specific industries that we're trying to disrupt.
Thanks for sharing that, Meg. I think I wish I recalled who shared this comment with me, but somebody once told me angel investors are not betting on the horse, but on the jockey, right? And I think that goes back to your comment of how important the team is, right? Sometimes we get these brilliant ideas, but if you get the team that may not be able to execute it, well, it may still, stay as an idea only. But then sometimes you may have these ideas that may not be the greatest idea ever, but you have such a good team behind it that all of a sudden you see execution go up and they make something real big out of it. So I think I agree totally with you in regards to your team comment. So
Yes.
Thank you for sharing that, Meg.
Yeah, I think it's a lot easier to validate an idea than a team, for sure. So totally agree.
Great. And Clayton, what about you? Do you share the same comments? Is there anything different that you look for when evaluating deals? You're a CPA guy, so I'm sure you're probably going to mention something about financials.
Well, actually, I might surprise you, Sebastian, because I've tried to branch off on just the financial numbers, although they are real important when we start getting into the pitch conversation and what it takes to actually write a check. But first off, I want to support and what Meg's comments were, because I think they're right on. It's something that I had to learn because I'm new to this space. Number one, I'm new. Two, I'm an oil and gas, energy, and retail guy. So when you enter into this space, it's software, right? There's it's biotechnology, and there are two industries that I really don't know a whole lot about. But I've come to find out that, you know, as I've formulated my own investment type strategy, which is in a lot of angel investing, it's very subjective and not objective. So you've got to have a good feeling for the founder, and can the team implement what they're trying to do? That's one, which is what Meg talked about. And I try to look at what they are actually trying to accomplish. And I have this matrix in my head, and I put it down on a piece of paper. It's called my innovation and disruption matrix. So if you figure that the y-axis is innovation and the x-axis is disruption, the higher you go on those scales, the more of a chance that there's a moonshot opportunity to get a high return. Combine that with the credibility and the capability of the management team, and that becomes sort of the holy grail of investing. So when I evaluate, even though I don't have a lot of background in software or in biotechnology, if I get the sense of and feeling, and I can, and the management team can communicate to me that it's highly innovative, and here's why, because it's solving this type of problem or whatever it's trying to accomplish, and it's high on the innovation scale, as well as maybe it's a better mousetrap, and it's going to be extremely disruptive as it starts to develop. Then it's going to pique my interest, and it has to score high on that scale. It might be real disruptive, but it's really not innovative, and people can copy it. You know, this is what I'm trying. So I look at, well, what were the things that, what were the type of innovative and disruptive businesses that we all see on TV that we all want to invest in, right? Uber and Lyft as an example. And you go, really, the concept itself isn't that complicated, but the thought process and the implementation of, oh my gosh, I mean, when I was your age, because I just turned 60. So, I mean, if you go back 20, 30 years ago, I mean, the taxi cab business, you would never think, oh my gosh, you know, we'll never, you know, how are you going to disrupt and innovate that business? And really, it's the same business. We've just applied, you know, a software solution on the top that just connects. It's a middleman solution between the consumer and the provider. And so I try to simplify. The only way I can understand some of this stuff is to simplify it. So once I do that, and it's high on that scale in connection with what Meg said, then it really piques my investment interest.
Thanks for sharing that, Clayton. It sounds like that disruption and innovation is a key aspect of your formula. Obviously, along with the team, which is the first aspect that Meg had mentioned. That. So yeah, totally agree with that. What about you, Michael? Besides disruption, innovation, the team, anything else that you look for? Do you have a special formula that you usually use?
I think there's a level of intentionality that the best investors seem to have. You know, it's very easy to just only do a country club investing strategy. A lot of family offices get trapped into this. They only end up doing the deals that the family office folks meet at the local country club, or they hear about in the locker room there, which, you know, is really problematic. And so I think that also translates to individual angel investors. And it's important to sit down and say, okay, like, what are my goals in angel investing? What am I trying to get out of this? For some people, it's just to have fun. And then that creates a different type of investing parameters versus, you know, if your goal is to maximize outcomes, that's totally different. And those then lead to all the different kind of, you know, decisions that you're going to make in terms of how you go about angel investing. And you can create a methodology around that and all that kind of stuff. You know, for me personally, I don't like betting in spaces where I don't have what I would feel is an unfair advantage. Like, do I really deeply understand a space? If not, then I'm playing the have fun game. And so I've got plenty of fun. So I generally just stick to what I'm good at this point, which I feel like is tech, and then some kind of old economy businesses that I've involved in as well.
That's awesome, Michael. I think you also bring up a really good point, which is, if you guys are entrepreneurs watching this today, and you want to apply for funding for angel investment groups or for an individual angel investor, you may want to do a little bit of research on what their background looks like, right? Because a lot of time we all tend to feel much more comfortable dealing or investing in companies that we are able to understand, right? So I think that is a really good aspect of the whole angel investing formula, which is obviously we're looking at the team, we're looking at the potential disruption, but as an angel investor, you also want to get involved with companies that you understand what the business model looks like, that you may have some experience, or a little bit of background. So I think that's also important. Thank you for sharing that, Michael. I guess my next question will be, what advice, if I am an entrepreneur and I come to you, Meg, Clayton, or Michael, and I tell you, give me a piece of advice, I am trying to raise money, what piece of advice will you give me in order for me to successfully raise funding, either through an individual investor or to a group of accredited investors?
First thing that I would say that I think can be super helpful, and especially in industries where people do not have expertise, like what Michael said, is to get an industry advocate. So like, in my world, it's getting a GC that loves your technology to talk about all of the pain points it solves for them and to do reference calls. I think, like, for me, for example, when we're trying to look at biotech deals, I don't have any background there, and so we certainly shy away from them. But if there's like a source that can validate the technology breakthrough and really help me understand it, then I think that's a huge plus than other, outside of just hearing the story from the founder. The next thing I would say is to know your audience. I often get frustrated with this. I'll have some people approach us and say, oh, let's talk about your manufacturing operation at Caterpillar. And they have gone to my website, and that's where they've applied. Yet they don't know that they're not talking to Caterpillar or the OEM, they're talking to a dealer. And so I think it's really important to understand who you're talking to, what problems they're trying to solve, and at the end, finally, this is my last piece of advice, to make a very clear ask of what they're looking for. I think on this side of the table, we see a lot of different deals every day, and if the ask isn't clear and there's really not a next step, it gets lost in translation. And so I think that's another important piece of it, is just to know who you're talking to and ask them what you want clearly at the end of your first meeting.
You gotta do your homework, just like everything else in life, right? Gotta do your homework, gotta know what their interests and motivations are, and just basically just gotta know who you are talking with. I think that's a really good advice. Thank you, Meg. Clayton, what about you?
Wow, Meg making a lot of really good points, that's for sure. Okay, it's not fair she gets to go first and take a lot of this stuff, but I'm going to step back and talk. When you're trying to raise money, you do need to understand your audience, and it's not everybody that's going to know about biotechnology or software. It's likely there will be a lot of individuals, or at least a group of individuals like myself, that are in different industries that are not necessarily, they have money to invest, but they're not familiar with the specific industries that a lot of these entrepreneurs are playing in. So for me, the ability to have that management team simplify their presentation to communicate, because you're not going to have a lot of time, right? You're only going to have 10, 15 minutes. It's almost like an expanded elevator speech, to tell everybody what your product or your solution is, to communicate this innovation and disruption. But it's going to be to an audience that may not have the depth of background that those entrepreneurs have. So simplifying their presentation and communicating to everybody in the room is real important. And that, what I find is a shortfall in a lot of presentations, Sebastian, is really defining the problem that they're trying to solve or what they're trying to address in the industry. I've done some biotechnology investments. One of the reasons why they're not that popular is it takes a long time for them to reach maturity. And you need to realize that when you do that. But a lot of biotech guys, when they come off, and I say guys in a neutral, men and women, is I don't understand what they're doing. I mean, it's extremely complicated, but they can simplify it down because a lot of them are engineers and scientists. They can simplify it down. So simplification and communication of what you're trying to solve and why your solution needs, why it's going to be successful, and then try to communicate what you need the money for, which is what Meg was saying. Be clear in terms of the ask, and then I'll take it a step further, Sebastian, because I do have a CPA and a numbers background, but I need to get a sense that the individuals have at least an understanding of finance and cash management 101. So I mean, you're not going to be a chief financial officer. You may not have gone to the Harvard Business School and understood, but simply asking somebody, how much cash do you have in the bank? If they can't answer that question, I mean, that's a telltale sign of, okay, what is your burn rate? What's your monthly burn rate? Not just a guess, but people who just have a handle on simple cash management and cash flow concepts is important to me, especially because I'm going to be writing them a check. So they're taking some of my money, and I want to make sure that they're good stewards of it. So that's it. That's important to me. And I'll leave it at that.
You know what? I can totally relate to the comment that you mentioned earlier. When we get companies that apply to Alamo Angels, specifically, one of these services that we offer them, it's to go through pitch coaching sessions, right? So we want to make sure that we first choose the best out of the best, and then that they are ready before we put them in front of our members. And a lot of times the coaching that we provide them with, or the feedback that we provide them with, is try to explain what you're trying to do as in simple terms as if you were explaining it to your grandma, right? So a lot of times we get these people that are, again, going back to the whole disruptive innovation aspect of what you guys are looking for. They come up with bioscience deals, or they come up with these very technical deals, and they use acronyms, or they use, right? So we want to simplify all of that. That we want to make sure that when you are an entrepreneur pitching to an angel investor, you are going to have a lot of different backgrounds sitting on that room. And so you want to be able to simplify it in such a way that hopefully every single person that attended that pitch event will be able to understand what you're doing. So I think that's very, very good advice. Thank you, Clay. Michael, what about you?
Yeah, great stuff said, and totally agree with all that. I think that there's this other idea that I see a repeated problem where people don't think about the fundraising process the right way. They think about it as, what can investors do for you, right? When you're fundraising, and the reality is, it's a sales job, right? You're out selling the vision of your company and the way that you're going to take the investors' money and use that to then meet the needs of those investors. And that's where it's so important to sit down and understand, and even ask the investor, like, why are you talking to me today? Like, what is interesting to you? What are your parameters in terms of what you're looking for in an investment? And you can tailor your pitch and tailor how you talk about your business that way. So, for example, I've sat down and I've raised money before for things, and you ask, what's important to you, Mr. and Mrs. Investor? And sometimes they'll say, well, I just want to have fun, right? Or I believe in your mission, or I like you, right? Nobody says that to me, but they might say it to other people. And, that's the kind of situation where you can then be able to understand that you're in a problem solving exercise for them. You're trying to create value for them. And you're doing that by starting with what they need rather than what you need, right? The world doesn't owe you anything as an entrepreneur. And it's your job to help others, and that way you get ahead.
Thank you, Michael. You've talked about pitches, and I know that Clay earlier talked about the short time that these entrepreneurs get in order to get the message across and hopefully convince investors that they are the right company for them to invest on, right? So maybe if we take it a little more specifically when we talk about pitches, do you guys have any do's and don'ts when it comes to pitching? And just to be fair, let's start with Michael. That way Meg doesn't take the good answer first.
Well, Meg's awesome. Meg deserves to give the good answer first. But the biggest thing that people do is they get fancy with their pitch. I think keeping things simple, just be direct. There's a common way that different types of investments get talked about, right? If you're raising a fund or you're raising money for your startup or you have a real estate deal, the investors like to see things that they're comfortable with your pitch format, right? That's the way they're going to process it, because everybody talks about it that way. If it's a tech startup, it's like, tell us your problem, tell us the problem you're solving, tell us the solution, tell us how you're going to make money, like da da da. And that ends up being 12 or 15 slides, depending upon where your stage of your business is. So yeah, it's kind of, I would say for sure, figure out how what you're pitching is normally pitched to the type of investor you're going at, and then just copy that format. You don't need to get creative on it. Nobody wants to see your stupid YouTube video. Like, if everybody's accustomed to seeing a pitch deck, right? Like, just do it the way everybody else does it, and keep it very straightforward, very simple, and go from there.
All right, simplicity is king for Michael. What about you, Clay?
So I'm going to get back to and repeat something I think Meg said earlier, and that's be very clear in terms of what you're asking.
Clay, the whole reason we let you go first before Meg is so that you wouldn't steal her answers.
And I'm actually, I think this is great, because I'm actually learning from both Meg and Michael along the line. And I like being in the middle. So I just wanted to say that, but it's true. You'll get through these pitch decks and the pitch is over, and I don't even know what they're asking for, like how much money, what the form that they're asking for is, and why they chose that form. Obviously, there's a number of different types of investment vehicles you can have, right? It could be straight up equity, it can be convertible, it could be a safe note, et cetera. But I get a lot to the end of the presentation and I don't know what they want, the dollar amount that they want. And then I don't know what their valuation is, or how I relate to the rest of the investors. And I don't know, am I going to be a preferred investor, a common equity investor, how much they've invested into it. So it's important for me to know that. And then I know that obviously can be a subject of a follow-on conversation, and typically it is. Obviously, I don't know of anybody who starts to write checks and not understand what exactly they're investing in. But I do think that at least it warrants one slide or one high-level discussion point. So it won't waste my time for me to go on, and do a follow-on conversation and maybe do a deeper dive. Because if I find out, if things are hitting me like your valuation is just completely disconnected or disjointed to what your presentation just said. And I think the reason why some people don't put it in there is they're unsure about what they're actually going to say. And so you better be sure that you really know what's in your presentation deck, because you are going to get some follow-on questions about it. And then if they don't answer them crisply and succinctly, then it's going to get to Meg's other point of, well, I'm really investing in the person, right, and the management team. And if they aren't quick on what they know and they're not able to answer the question quickly, then that's not going to be a good sign. So,
thank you, Clay. You also touched on a good point, which maybe if you guys are not familiar with the whole angel investment process, I think most angel networks, what they'll do is you come and pitch to the angels. Again, it's a short format, it may be up to 15 minutes, right? Including the pitch as well as the Q&A. But then you usually have some sort of follow-up depending on the network that you're dealing with. Here with Alamo Angels, a week after you come and pitch to our group, then we have deep dive sessions with you. And that will be an opportunity now for investors to fully understand what it is that you are dealing with and what it is that you're talking about, right? And perhaps fully understanding it is not even a fair statement, because then again, it's only 1 hour. So this is in order for you to achieve your end goal, which is to get funded. It's probably going to take more than that pitch event and more than the deep dive session. but it's part of the process. So I guess you brought a really good point. And if you guys watching today are not quite familiar with what the process looks like, hopefully you get a little bit better understanding of how the different steps look like. Meg, what about you?
I know we're all echoing each other, but I'm going to do it again. So, going back to what Michael said, I think figuring out what is the norm for the industry or the company that you're pitching, that's important, and being concise. Furthermore, you are very rarely talking to a robot, and I often feel like that is how people pitch. They just talk, don't pause for questions. It's kind of like your eyes glaze over. And so if your own eyes would glaze over listening to your pitch, I think that you need to rework it and make sure that there's an opportunity to engage and really try to engage the audience. I think that people try to get through things really quickly, or don't expect that there won't be any question. It's almost like they're expecting that you're going to pass on the investment immediately. So I would go in confidently and trying to engage the audience. The next thing that I'll throw in that's a little bit nitpicky is if you're going to name drop, make sure that you can validate those through making an introduction for a reference call. That's, if it's actually just more confusing for me when people put it in their deck, but then they can't make an intro. It actually works against them. So I think it's okay to put, if you think that somebody that's well known, would having their name in your pitch deck would make a difference, that's fine. However, if you are unable to make a introduction to them and are not at that level of relationship, I would absolutely not include it.
Thank you. That's a really good point, Meg. So we actually, as angel investors, we do follow through with those references. Just like when you apply for a job, you better know that somebody's going to get a phone call to ask how you did when you were working for that person or for that particular company. So important for sure. Now, we've talked about a lot of different things, and I guess the most important question, which I'm saving for last, this is only 1 hour session, guys, by the way. So if you guys have any questions for you watching today, make sure to send them through the Q&A. We'll be happy to answer those questions, and we're gonna leave some time towards the end of the session for our panelists to answer those. But before we get to the Q&A, I want to ask this last one question, which is, what does it take for you to write a check? Let's start with you, Clayton.
All right, I got the easy one because I actually have some props. It takes to write a check, it takes a checkbook and it takes a pen. And as simple as that sounds, look at Michael, that was funny, but it's true. That's what it takes to write a check. On pitch events, generally speaking, most of the people that are attending these pitch events have capital to invest. Most people don't attend for fun. There's other things that they can do. And obviously there is a social aspect of pitch events. It's been taken away through all the Zoom and the COVID and all this other stuff. But if somebody's attending an event, they actually have the capital to invest. So it's up to the entrepreneur to convince the individual to part with their capital. And so, but it's real easy because if you have that audience, they're ready to go. So, and then I want to back up and add 2 more things that I think, I want to address some of the other questions and then I'll move on to Meg and Michael. But, another aspect of the management team that I like to evaluate is to see if the team is coachable and takes constructive criticism positively. These events are not, I don't think I've attended an event that emulated Shark Tank, which is a lot of people confuse as where you're going to get into this aggressive situation. That's not the case at all. The investors just want to understand what you're pitching and what you're asking for. And if it fits their criteria, they will part with their capital. And as part of that, in terms of taking constructive criticism positively and being coachable, they need to be ready to, even though I think for the most part, investors are very respective of the entrepreneurs. Sometimes the entrepreneurs will get a feeling that somebody's calling my baby ugly. Now, we've all, I mean, I've had 4 babies, you know, and I thought they all looked great, but let's be honest, after they weren't all that pretty. Entrepreneurs dedicate their entire life to their business. And so they believe it's the best thing on the planet. And when they hear some type of what they perceive to be criticism, they can get defensive. It's not because somebody's calling your baby ugly. It's because the investor really wants to understand what they're getting into before they release their capital. So I just wanted to get those last 2 points, and I was looking down at my notes, and I apologize for Sebastian. So I answered more than you wanted to. But people, when they attend the pitch events, they do have an interest in investing.
Thank you for sharing that, Glenn. I think this is totally important, and the whole coachable aspect of it, it's definitely in a lot of people's criteria, right? You want to make sure that you have someone that you can actually have an honest discussion with. And again, you earlier today, you've mentioned about you are actually giving them your money. So you, at the very least, you want them to hear some of the ideas and guidance that you may have for them, and hopefully they'll apply it, right? So those are really good points. Meg, what about you?
Yeah. So I'll give a pretty concise answer, which is what it comes down to at the end of all the diligence with the founder, the team, the problem that they're solving, and, you know, kind of validation around that is the total size of the round, how much runway it's going to provide, and what the likelihood of them actually getting that entire size of the round is. You know, I think we generally can go in very early and before the whole round is committed. But when we do that, we have to have serious confidence that that they're going to get the rest of the round in the runway that they need. And, you know, I think that is like the death trap is going in too early, or in them not being, in you being the last money that they ever raise. And so I go in to kind of every new investment that we do, hoping and planning for if we're the only one that they can get confidence from, and trying to make sure that we back them up. And you know, I think the question for the founder at that point is, how can you help me with other investors? If you're going to put your money in, then I need your backup as well. And so really for me, that's where it does get back to kind of like the brass tacks is, how much money are you going to get, and how long is it going to last you, and what's going to happen if you have to extend your runway.
Thank you for sharing that, Meg. I think those are really good points, certainly. So, Michael, we leave you for last. Let's see what you got.
Oh yeah. Well, I think to add on what the other folks said, you know, I really am now gravitating more towards investment vehicles where I can be very active. I have found that, you know, doing the fire and forget, give somebody a substantive check and then hope and pray, that's just not very fun, right? So I'm more interested in taking larger, more concentrated investments. And those can be really fun and rewarding. So I think that, plus all the things that you heard from Meg and Clay, for sure. And the other thing I've learned from doing this for a while is, especially at the early stage, there's a few ways that businesses can go really, really right, and there's a million ways they can go really, really wrong. And you know, to pull the trigger and invest in somebody else's company, you know, really all the boxes have to get checked. And you know, that I think comes back to angel investors that are doing it right. You know, your funnel of how you look at deals should be hundreds before you winnow it down to a handful that you look at extremely closely and due diligence on, and then just a one or two that squirt out the bottom of that funnel that you actually write checks around. So that's the one thing that people don't really think about when they get into angel investing, and also that founders don't really think about, is there's a really sucky aspect of being an investor, which is it's not that much fun to tell people no, like all day long. And you have to if you're going to be doing it right.
Thank you, Michael. Well, I think 11:45, right on time, we are going to open it up for Q&A. And if the Startup Week team can maybe facilitate some of the questions, that'll be great. I can only see one question here from Mark Solis, and he's asking, what industries are your firms most heavily invested on? Not sure I totally understand that question. I'm guessing what industries are you primarily looking at when making an investment? What about you, Paul? Meg, I'm sorry.
Using my last name and my first name. Yeah, so I think I made a little bit, but we look a lot at industrial technology. So that includes construction tech, some manufacturing and robotics. And I mean, it's pretty broad. And then we look at a lot of enterprise SaaS actually, that we can use within the actual support operations of the dealership. But primarily we are pretty skewed towards industrials.
Thank you. What about you, Clay?
Well, I have a pretty diversified industry portfolio in terms of angel investing. So I think I have, I mean, I think 5 or 6 angel investments, but they're pretty diversified. Maybe if there was a concentration, it would be software as a service, but that software needs to be something that I can understand. So that the artificial intelligence aspect of things is something that it's hard. I mean, data mining, artificial intelligence is a little more difficult for me to grasp onto. So I don't have much of that. But I do believe I need to have, one, to be successful in this, you have to have diversification and you have to have a number of different investments. I mean, to think you're going to invest in 1 or 2 companies and think that's going to work, it's really not. So, I mean, you really need to get up to 10. And that's why investing in angel funds, right? So is also part of your, an individual's portfolio where you're going to get some instant diversification. I think that's positive. And then you can evaluate what that fund is doing. And most of the funds will allow you to do sidecar investments where you can go off, and if something's really intriguing to you, then you can sort of piggyback off some of the due diligence that's being done by the fund itself. So I think those are positive.
Clay, you mentioned SaaS type of companies, and I often hear a lot of investors who want to focus on that particular industry. Is it because of the scalability aspect of it, or what attracts you towards that?
No, I think it's easy for me to understand if that software is trying to solve a problem. I think my thought is it might be the coding itself is not a differentiation. It's really solving the problem. And although that can have it can be problematic from a patent and a moat, standpoint of competition. So you have to weigh that in. Is somebody going to take your idea and reprogram it better? But it's not very capital intensive, and it's not inventory intensive. But I can tell you that because it doesn't have inventory, right? It's not a machine that ties up a tremendous amount of capital that you've got to get that return. So investing in SaaS companies, it's like every dollar that you invest is going directly into the revenue generating aspect of the business.
Thank you, Clay. Michael, I think you answered this question before, but if you don't mind, remind us, what type of industries are you usually investing on?
Yeah, I like to focus on where I feel like I have an unfair advantage and expertise. So some kind of classic Main Street businesses, and then software and tech, I think are what I really like. And I think I've started to transition more into this model with more deep involvement and fewer investments. So kind of contrarian to the way you're supposed to do it. Clay talked about the optimal way, if you're just allocating capital into these companies, is to do 30, 37, 40 deals to kind of reduce your risk of ruin. And I'm doing exactly not that. So it's pretty cool. But there's lots of, that comes back to kind of the idea here. There's lots of ways to skin the cat. But yeah, I stick to stuff I know very well. And that's tech and some kind of Main Street style businesses.
Thank you, Michael. We've got another question here on the chat. When is there too many people involved, and when is there too little people involved to invest in?
Oh, can I talk about this? This is total pet peeve.
Yes, go ahead.
Yes, and then I'll give an answer, then Meg can give the correct answer. So everybody thinks for some reason that if you put a bunch more people on your slides for your startup, it's like a really good thing. Like, oh, we've got all these advisors and board members and service providers and all this stuff. And like, you'll look up at these companies and realize that there's 30 people involved and nobody who's truly committed, like nobody who's really there. And you'll have seen the founder gave up 40% of the company to all these randoms who have day jobs who aren't really adding any value whatsoever. And it's actually a huge detraction. And I've looked at deals, for example, where there's two founders, they own half the company, and before they've even raised any money, they gave the other half of the company to a bunch of people who are just whoever, right? Advisor, blah, blah, blah. And you'll see the slide, which is like a bazillion people on there. And so, I think that comes back to what investors really care about, which is who is truly committed to making this business work, especially at the early stage. And having more quantity instead of quality on your pitch deck is just totally counterproductive. It doesn't help. Now, there are exceptions, right, where some magical general or whoever who can help you get XYZ into this particular first customer you're going to get, that totally makes sense. But that's like 5% of the situations. All the rest of the time, it's just founders showing that they're making bad decisions from day one.
So I'm very passionate about that one, Michael.
Huh? Yes, I am. It gets me really mad.
Clay, what about you? We'll leave the right answer for last with Meg.
Yeah, because I really don't have a firm opinion on it at all. I think my point would just from an investment, you can't have enough money, you can't get enough capital when you're trying to raise. So you're going to have to, for those trying to do fundraising, you're going to have to cast your net pretty wide unless you're going to have people write big checks. But and there are individuals obviously who have the capacity to write some pretty big checks, and funds can do that. But one of the things that this may not even answer the question, but it's something else that'll remind me of watching the presidential debates last night, where you ask a question and who the heck knows what the answer was going to be, what people are going to say. But for individual, I think people lose touch, like say a $50,000 check. $50,000 is a lot of money. Most people don't make that much. Most people don't make that much in a year. And so I think recognizing that if you're trying to raise $500,000, you're going to have to get 10 people to give you a $50,000 check. That's a lot of work. That's 10 people, 10 man years worth of compensation. So that's the struggle you're going to have. Now, there are individuals that, money is just free flowing, but certainly in today's environment, even in COVID environment, people are it's tough. It might, but there are people out there that do that. And so that have the ability and they're willing to do so. So it's not easy. I think you need people who are listening, you just put all together what they've heard and kind of boil that down to what they're trying to do. Anyway, that's it.
Thank you, Clay. All right, Meg, your turn.
Got to struggle through this one. I can't keep up with the right answer though. But I guess I'm unsure of how to answer this in a straightforward manner. But the first thing I'll say is that I'm a big believer of small, scrappy teams with people that can take on a lot of responsibility. I think that's who you need at a startup when when you are raising for the next year of life at a time. But as long as the employees, that you have can be, it's validated that you need them within the raise, then great, have them. My view on advisors, I guess it sounds like maybe is aligned with Michael. however, I'm maybe a little more passive about it, that I don't totally care. If you have a lot of advisors and you want to put them in your deck, then whatever. If you're paying them some kind of weird fee, retainer, and using your investor money on that, it's like, then I don't like it. But if it's a non-cash item and you think those people help you, then whatever, I don't really care. But I think it just comes down to, where your money is going and what are those advisors actually contributing, but it's kind of a passive answer.
All right, well, I don't see any more questions. And it's almost time anyway, it's 11:55. This was a 1-hour session. I know that time flew by. We were having a really good conversation. I hope that you guys at home watching this got something out of our session. We've got really, really good opportunities here to learn a little bit more about what our angel investors have in mind when it comes to making an investment on an early stage company. If you guys have further questions, or if you guys are in San Antonio and want to get connected with an angel investment group, please know that we do exist and we are Alamo Angels. So take a look at our website, and I'm the executive director for the group. So any questions that I could answer for you guys, I'll be more than happy to. You can find my information there on the website. Any final comments, guys, before we finish today's session?
No, great job.
Thank you, Michael.
Yeah, great job, Sebastian.
Clay, Meg, Michael, thank you so much. I hope you guys have a good Friday and a really good weekend.
Thank you.